Thanks so much for tuning into today's Talking Point. I'm your host, Niraj Shah. It's always a pleasure to get in the Frank Ajay Srivastava talking about how he sees the markets and risk assets through his prism. Today, I assure you, will not be any different. Ajay, great having you. Thanks for taking the time out.
Morning. Good morning.
Ajay, you were admittedly not the most constructive on markets except for select pockets. And I reckon in some part, that is what has worked out. Though, yes, the Nifty's also rallied from circa 19,300 to about 20,200 as the case may be. What do you feel about Indian equities at the current point of time?
First of all, it is, if you see in the Indian market, you have seen now very clearly that there are waves of movement which takes place in sectors. And therefore, if you have to keep pace with your returns versus debt returns, I keep saying to myself, it's not about how much you make in equities. Are you making a superior return than a risk-free debt return or a reasonable debt return? Because if you're not making 18% odd compounded year on year or 16%, you're not doing justice to your portfolio. Your stock may have gone up by 10%, but that's not worth the risk. So keep in context that are you able to generate superior return than you can do in a debt scenario. Now, having said that, now you saw in the last 2 years what happened. We had a banks which are in uplift. Then the banks have stabilized out, given no returns. Then it was an era of pharma which came into place, and that has kind of now peaked up a little bit, and now it's on a flat trajectory. We had capital goods which came for the last 3 years, which gave phenomenal returns, still very strong thesis going on. And the last big block has been the defense sector, which has done wonderfully well, continues to do well, purely because there's a scarce supply. There are no companies in the sector. There may be 6-7 companies. So I think Indian equity market also is driven by, if you were in commodities or a steel or this thing, you wouldn't have made any returns of any kind in the last 12 months. So I think more than the construct of the Indian equity market, I think you need to construct and say where your portfolio is focused, unless you can sit with an index fund and live with it for the rest of your life, which is fine as a strategy. But I think the key thing we keep saying is that compared to the earlier time when you could keep a share for 10 years, today when you keep a share for 10 years, you possibly don't generate return. HDFC Bank is an ideal example. Phenomenal returns to mediocre to low return. If you look at 10-year trajectory, it won't even meet an FD rate of return. So I think the theme of the market is you need to be with the momentum a little bit. You need to go with the flow. If you had invested in a chemical industry at the top end of the equity cycle, today you'd be sitting in huge losses. So while equity market has gone up, people who held chemical stocks are wondering what happened to their portfolio. So I think the name of the game is, to my mind, is churn. Name of the game is momentum. Don't focus on the market. Market doesn't take you anywhere unless you have the right stocks for the market at the end of the day.
Yeah, well, viewers, that's a pertinent point, right? You don't have Nifty futures in your portfolio, I'm presuming. So the idea should be to be in the right quadrant. Let's ask Ajay Srivastava, what are the quadrants that look compelling right now? Ajay, with a presumption that you still find value, or by value I mean the thought of investing into them because they will create wealth for you. I believe you still find value in select pockets. Would that be a fair assessment that there are still investable options there?
Oh, certainly. Certainly. I know there can be a generic view that the market is expensive, which is fair market. But at the end of the day, market is what it is. It can become irrational for years for that matter. But the key point is the Indian economy has opened up so many new sectors and companies, which were not used to be in a portfolio. Whether it's a new age company, whether it's a defense portfolio, whether it's a services company, that today the options of taking your money into new companies has increased manifold. And that's the important part. That, earlier used to be, Reliance Lilo, Infosys Lilo, Lilo, but now today, you got beautiful new age companies. Whether you like it, don't like it, you do order Zomato, you do take Paytm as generic as a Godrej Boys can be. And for disclosure, we hold shares, so we're not advocating it. But the fact remains that these choices, the investor 10 years back did not have, 5 years back did not have. So my view is always that there are new companies coming up, new sectors coming up, and you need to get into them. Yes, they may be expensive, which means keep your powder dry. So when there is a correction, and there's always a correction, okay, you are able to add on to the portfolio. If you've exhausted yourself, you're out of the market at that point of time. So the key is pick out your sectors and all new sectors. Don't need to go for fuddy-duddy, cement, steel. They're not going to give you fantastic returns. You need to go for the newer companies, newer sectors. You saw what happened to the airline lounge company. You saw what happened to Indigo. You saw what happened to hotel companies. I think newer sectors, you want Zomato, Paytm, you name it. It's phenomenal. Indian equity market gives you so many new choices, Niraj, that today one is spoiled for choice. You wonder where do we get the next money? to invest. And some themes are for long-term real, is like defense. I don't think you need to cash out defense for the next 5 years. It's a very long-term theme. So good spaces, good thing. Yes, expensive. Keep my powder dry. Buy when there is a correction. But staying out, I don't think is a good option.
Interesting. On defense, Ajay, people cite how the book-to-bill ratios for defense companies have always been good, but cash flows have always come back to be the bugbear. Why is it that this time is different? How would you say? How would you respond to that?
For the simple reason, like all Indian markets, the flows make all the difference. There is phenomenal flows coming in defense sector because there is one sector totally underinvested by most investors. If you look at HNI, portfolios, mutual fund, none of them are equity. Unfortunately, there are a lot of PSU stocks there, which puts high risk on what you do. But the fact remains that if India is going to buy 40, 50,000 crores of defense equipment from Indian companies, it is going to come to Indian companies at the end of the day, whether it's a Mazagon Dock or it's a Garden Reach or it is any other private companies. And this theme will remain because given where our rupee dollar is at 83 almost today, and it continues to fall, it's an historic low. India has no option but to develop indigenous. You can't keep buying foreign planes, you can't keep buying foreign goods because you can't afford to buy them anymore at this point of time. So I think the theme is there for long because India's defense requirement remains. Beautiful thing about defense is that unlike other things, airport which lasts for 25 years, defense equipment needs refurbishing, maintenance, spares, and replacement. Now that's a virtuous cycle for most companies because, as you know, auto companies make more money on replacement parts than they do on the cars, basically, at the end of the day. So imagine so much of defense equipment being bought today will be maintained by these companies, spares, repairs, replacement. Phenomenal demand cycle for these companies, and best part, market is still underinvested because there are not many options. So money chases stocks, stocks go higher.
Okay, fair point. One realizes that the money is also chasing luxury items in a meaningful way, Ajay. There are now niche plays, but plays available to ride this, you know, luxury buying binge that select pockets of India seem to be in. What are your thoughts here? There is a watchmaker, there is a car dealer, there is something else, there is a winemaker, niche plays, but are these exciting?
See, you're right. Luxury is the biggest consuming and purchasing segment of this country by and large. There's no doubt in my mind that consumption pattern is not faltering at all. The problem is how do you participate in the luxury market? Most foreign brands are not quoted here at the end of the day. Your only option is retail to some extent, but retailing also is privately owned, like Tata Click, etc. is privately owned. You can't go there. Yes, there are a few good car companies, like say Watch Ethos, distribution company, not production company. Like, just to name, I don't have an equity, it's done remarkably well. Ethos Watch, they are a phenomenal distributor at the end of the day of the luxury watches. But, at the end of the day, distribution companies can only give you so much mileage. But the real trick is to see whether you participate in the real luxury boom. And I think people are doing that by different ways. People are doing that by expensive real estate. People are doing that by painting. Unfortunately, capital market is not able to capture a lot of the stuff. People are doing by cars, but car company, distribution company can make only so much money at the end of the day. It's not an equity investment. It's a transition investment. You don't buy a car dealer company at the end of the day. I don't know. That doesn't sound to me okay to me. But the fact remains that wherever you see pockets of luxury, which is hotels, where you can directly participate, I think that's a great place to be because this cycle of consumption is going off in a different tangent altogether. Expensive consumer durable companies, I think they are fine, absolutely. But hotels possibly represent the best single luxury segment that equity investors can participate in.
Got it. Okay. That's a point well taken. The other pieces, and I'm drawing your thought to the first answer that you gave, that if people bought into chemicals at the top of the cycle, then they would be lamenting, and rightfully so. The question is, after this 1.5 to 2.5 years of hiatus that the chemical stocks seem to have taken, and the valuation correction that has come into some of them, say for fluorination companies, is the tide turning? Do you sense fundamentally that things could be turning around for the specialty chemical space?
Not till last month. In our calls with the customers, market visits, I've seen not in the last month. I think the global demand itself is kind of edged down at this point of time. And certainly with the oil prices peaking up again, The margins are going to get under further pressure at this point of time because that's an input into most of the material. But we have not seen any significant demand uptick, neither domestic, neither international, in any of the major chemical segments. Having said that, also what is happening, Reg, is that these companies are now coming up with huge capacity expansions.
Yeah.
So if you see at the height of the boom, they did huge expansion, which is now coming to the market. So I think there'll be reasonable pressure on their margin, reasonable pressure on the ability to perform, and still they're not cheap. We are not, we're not talking about
I think we seem
all
to...
in a P's in the range of 30 to 50 P's at this point of time. So it's difficult. And therefore, I would still say that in India, your better bet is you focus on consumer segment more than front-facing domestic than the industrial segment. I think you'll make better returns on companies focused on consumer than companies focused on industrial.
Okay, just one final question, Ajay. With the presumption that you are saying, my presumption is that you're saying that don't look at the markets per se. The markets may even show a correction, but specific pockets could continue to do well if there is promise there. Is that a good premise?
Oh, it's a good premise. And corrections, deep corrections are your best friend. You've seen nothing happen to IT industry, but the market price corrected so beautifully that you could get an entry chance and made a very good return in the last couple of months. So I think sectorally, keep watching good companies, strong corrections should be your guiding star, not 52-week high and overbought companies. I think that's where the danger lies. So I think this is where your mantra should be. Be patient. Market gives you a chances again and again. There's no problem with the chances. Don't worry. Don't FOMO. No runaway. Patience. Invest where you like. Invest at your time and choosing, not when the market drives you to pick up the stocks.
Okay. So with that, the premise, my final question, Ajay, is this. I want you to tell us, how do you look at this industry that you briefly spoke about, right? Food ordering. And the reason I bring it up is in the last 15 days, I've spoken to 4 investors, 3 on air, 1 off air, who told me about their thoughts around why a Zomato or a Swiggy, which is coming as an IPO, could be a model which all of them looked at it very differently. And therefore, their thoughts around what's the kind of returns that could come in were very, very different. But the common central theme was that very early in the industry life cycle, we seem to have a duopoly in a large market like India, which is a very big moat for both of these names, for now only Zomato. How do you look at food ordering business?
Okay, we have a holding, so that to the extent disclosure, I think it's a multi-bagger kind of scenario because it's not even touched really 5 to 10% of the market. Huge market, huge segment. It's not easy to duplicate it. And moat to duopoly doesn't mean you make money always. You look at telecom, is an ideal example to say duopoly never made money at the end of the day. Okay, that Reliance stock, what's been done to Reliance stock, and Airtel has given very mediocre. So it's not necessarily a duopoly. I think what's more important is the focus of the companies to get to profitability stage while keeping their cost of distribution, cost of operation low. I think that's where the mantra is. That's where this thing is. So my belief, food ordering, and food ordering can extend to many other things. Tomorrow it can just take on a pharmacy and say, you have a logistical base. You can go to pharmacy. You can go to any other product. You can do agriculture inputs. At the end of the day, your base is a strong IT-driven distribution. The product could be food, medicine, could be any product at the point of time. So, and you've seen what happened to Blinkit at the end of the day. There's nothing to do with food, but Blinkit, everybody is like nomenclature is, you run out of sugar and you say, just Blinkit. It's like that kind of nomenclatures are developing. So these phenomenal events happen once in 20, 30 years where companies with generic names, like we discussed Paytm, come through and they become a regular word of usage. And these companies offer, not only the moat, what you said, but also the customer appreciation because they don't need large capital once they grow into a profitable stage. And which is the beauty which I like about companies is if you're not diluting capital and making money, I think you're good for the shareholders.
Got it. Ajay, lovely talking to you as always. Thanks for your time.
Thank you very much.
And have a great weekend.
All the best. You too. Thank you very much.
And viewers, thanks for tuning into this edition of The Talking Point.